I'll start. Yeah, Mudiji, you are live now.
Good afternoon, everyone, and welcome to the webinar. Before the panel discussion, we would be sharing with you the status of Indian renewable sector in the aftermath of disruption created by the COVID-19 impact. This presentation can be downloaded from our website and need not take the slides accordingly. We'll share it on our website, which can be downloaded from there. As part of this presentation, we will be taking you through 4 sections. The first is on the introduction of Tata CleanTech Capital or TCCL. We are part of Tata Group, a group which doesn't require an introduction per se, which is known for its philanthropic causes. And furthermore, we have been pioneer in taking steps ahead of its time. And one such step is creating Tata CleanTech Capital to focus on climate finance. Now, Tata CleanTech Capital is a green investment bank on the private money, which will be operating in the emerging economies. It's a joint venture between Tata Capital and International Finance Corporation, focusing on project finance, debt syndication, and advisory. The first private sector entity globally to partner Green Climate Fund or GCF in mainstreaming solar rooftop market through $100 million credit line. It's the first Indian entity to join Global Green Bank Network. We operate in all the clean tech sectors, which includes the now matured utility scale solar, wind, and about nascent stages such as distributed solar, energy efficiency, electric mobility. So far, we have financed over 12 gigawatt of capacities, which is helping mitigate close to 17 million tons of carbon dioxide emissions. We've also taken the advisory mandate with some of the large multilateral institutes. Now, coming on to the main part of market landscape during the pandemic. Here, in the first phase, just give me 1 second. Ritu, are you facing? Get unmuted. Yes, I'm back. Apologies for the disruption for the technical side. So once again, in the first wave of pandemic, the Indian economy was declined by close to 24% in the first quarter of FY21. However, the recovery has been quick, and this recovery has been made possible by the government measures. The impact wasn't huge for the second and the third wave. The key reasons behind it are multifold. First is the monetary policy by the government, in which the liquidity measures were relaxed significantly. Second is the economic measures. These economic measures include the corporate tax rate reduction, the loan moratorium to the developers, ECLGS scheme, direct benefit transfers, and partial credit guarantee scheme. To add to it, there were multiple measures for electricity sector alone. This included the liquidity package scheme for the distribution companies, the rebate provided to the distribution companies from NTPC and PGCIL. It also included reduction of letter of credit for the distribution companies and extension of project execution timelines. All in all, the sector bounced back. But this sudden increase in energy demand globally, because globally the market opened up, this led to sudden increase in the global demand, which led to exponential surge in coal and gas prices. Coal alone has increased between 2020 to 2022 by 8 times. The similar kind of nature happened for natural gas, where the increase has been close to 5 times. This increase is also necessitated by the drop in hydroelectricity production due to drought in China and Indonesia. Now, the wholesale prices, it surged globally in Q4 2021 because of it started with the extreme weather conditions in Japan and USA, followed by the increase in global demand per se. And the condition is same for all the countries, including India, where the electricity tariffs at exchange just 20 rupees per kilowatt hour. This made government to come out with a regulation to cap the prices at 12, started importing the coal power plants and increase the coal stocking norms to fight the crisis. Overall, the impact on the DISCOMs has been huge in this scheme of things, where they have been hampered by two factors. A, the demand from industrial and commercial consumers went down, which is the profitable segment. B, the billing and collection efficiency for the distribution companies are significantly hampered during this period. Then government came out with the DISCOM liquidity package. This DISCOM liquidity package was basically broken down into two parts, where both of this were linked to certain reforms at the distribution companies act. The lenders here were PFC and REC. The key features was that it's a concessional loan for a 10-year period. It had state government guarantee. It also provided it the main rationale here was to reduce the distribution companies ACS and ARR gap. However, even after the disbursement of close to 1 trillion rupees, overall reduction in the DISCOM dues was barely 3%. Where the renewable sector faced as a brunt was in this period, even when the disbursement happened from PFC and REC, the total outstanding almost doubled for this renewable sector. Now, impact on the solar project cost. Was my PPT not showing, Ramesh?
Yeah, your PPT is not showing.
Yeah, it's not
Ramesh, you should have stopped me from the beginning.
We can continue.
We can, but okay, I'll very quickly cover the parts on the impact. So in the first wave, our economy went down significantly, but the impact wasn't such high, or the impact was minimal in the second and the third wave. This bounce back was made possible by the government measures, which I have mentioned before. But this global increase in the demand led to increase in coal and gas prices. This coal increased by a factor of 8 times between 2020 and 2022. Gas price increased by close to 5 times during this period. Here, the wholesale prices also surged by close to 3 to 4 times in all the global markets. The condition wasn't too different in India, where the prices surged to 20 rupees per kilowatt hour, and it dropped to 12 after government capped it at 12 and asked for coal to be imported. Also, the coal stocking norms have been relaxed. The DISCOMs, for the distribution companies, the impact has been severe for COVID, but due to the DISCOM's liquidity scheme, government wanted to relax it so that distribution companies can become more sustainable. Even after the disbursement of 1 lakh crores, overall reduction in the dues has been barely 3%. But where it is making significant changes in the renewable sector, the dues has been doubled. So basically, this money hasn't really flown to the renewable generators. Now coming on to the solar project cost, where I was initially supposed to be. The polysilicon price explosion took place since June 2020. It started with GCL's factory catching fire, but it was only the tip of the iceberg. Increase in global demand has led to the increase in price rises, because of which the prices started keep on going up. Then China's emission control drive once again led to the polysilicon shortage. All in all, polysilicon prices touched the level which used to be there in early 2010 and 11. Such kind of levels were not anticipated before COVID related disruption. Add to it, it's not just polysilicon alone. The freight as a part become a situation which was never thought out that it could be such a big pain point for all kind of deliveries. With change in consumer habits or changing shipping routes, the prices of shipping, the rate has increased by 4 to 5 times. This is because of the congestion in various major ports across the world. Here, if we look on the overall impact, the module prices increased by close to 45%. This is despite safeguard duties being removed in July. But the raw material prices, which includes polysilicon, silver and glass, freight, and the GST duty being increased from 5% to 12%, led to this 45% increase. On top of that, the metals used in the solar project installations, copper, aluminum, steel, has seen an increase by 50 to 90% during this period. The project cost increase as a result between 20% over and above the 20% with metal supercycle, polysilicon shortage, and freight. Even during this period, the tariffs continued to remain flat. This does not include the BCD or ALMM impact. Even after that, the tariffs were within the range where distribution companies were comfortable with. Looking at the outlook per se, the renewable installation picked up post registering a fall in FY21. In FY22, both the installation as well as the tender allocation increased. Our pipeline increased significantly and started touching the level which was required for meeting our 450 gigawatt target. But the tariffs are the question where the project cost can it play an issue. So here comes the second problem of the market barriers. The inflation is ever rising, which is creating a problem of interest rate cycle being on the upward swing. Second problem being the Great Indian Bustard, where the key geographies contributing to bulk of the solar activities is currently under the purview of the committee. There are good market drivers, which includes the revival of or the reform for the distribution sector scheme, which is linked to performance. It's a 3 lakh crore or a $3 trillion rupee scheme in which 1.62 trillion rupee has already been sanctioned for multiple states for infrastructure upgradation and smart metering. The peak electricity demand in India has also been on the upswing, and the states were also showing positive revival in their demand trend. Lastly, the demand outlook for long term remains favorable. It's bolstered by the COP26 announcement and government making firm commitments. So let us come to our esteemed panel for the panel discussion. Over to you, Mithil, for taking it forward.
Thank you, Mudit, for the detailed presentation. This was quite insightful. Good afternoon, everybody. Maybe I'll just give some opening thoughts. So India obviously has, as we all know, been at the forefront today with respect to the greening of the energy mix. This has been supported by a strong push from the government and a lot of interest, obviously, from the stakeholders and investors. This is because India is probably one of the fastest, or probably the fastest growing market in this space. TCCL has been at the forefront in helping our customers address this issue of climate change, supporting them with their financing and other needs. Having said that, this entire industry went through a very difficult period during COVID, but the economy in general and the renewable sector in particular has bounced back with a lot of resilience post the pandemic. In fact, it's come back with a vengeance. Having said that, there are still a lot of issues, or there are certain issues and there are headwinds which could inhibit the growth or could prove a dampener in this journey for rapid growth, whether it is cost of materials rising, inflation, interest rates, and all of that. To help us decode all of this, today we have a very esteemed panel. So let us head straight to our guest, and I'm sure all of us will immensely benefit from the insights that we get from these industry leaders. Today we are joined by an esteemed panel. We have Tanya Singhal, founder and director of Solar Aris. Hi Tanya, welcome to the webinar. We have Ms. Ritu Lal, Senior Vice President and Head Institutional Relationships at Amplus Solar. Ritu, I'm assuming you're there. I think she's there, but the camera is off. And we have Nitin Bhatia. Nitin is the Head of Corporate Finance and Commercial Finance at Radiance Renewables, one of the fast-growing CNI platforms in the country today. So welcome all of you, and look forward to an engaging conversation with all of you. So I'm not sure if Ritu is there.
No, Mithilji, Ritu ma'am is not joined yet.
I can see her, but probably at least she's either on mute or something. Yeah, there she is. Excellent. Hi.
Okay. So you're on mute, I think.
No, Ritu ma'am has not joined yet.
She's there.
I can see her, Mahesh. I can see her right there. Just that she's unable to unmute herself.
Yeah, now she's there. Yeah, Mithilji, she's there.
Yeah, great. So
no, we can't hear you.
Rituji, you have joined. Rituji, you have joined over there.
Joined, but we just can't hear you. Either the microphone or some other glitch. So with the endemic, I think we are still not at the end of the technical glitches. That is still not ended. That part of our life continues, I think.
Yeah, I think now she can speak. I think the unmute has happened for Ritu.
No, but
we can't hear her.
No, I think there are some issues.
Why don't we continue and then
we can probably start, and we'll have we'll so I'll maybe we'll start with Tanya. Maybe it'll be great if we can have your opening thoughts in this matter, and just generally as to what you see, believe of the sector. And I had a specific question for you with respect to specifically something that has been the top of everybody's mind with respect to the global surge in the commodity prices, the inflation that we are talking about, and the impact that this has on the sector, especially with respect to the polysilicon shortage that has been created or the rising prices. So I think your opening thoughts as well as some comments on this specific issue would be very useful.
Great, thank you, and good afternoon, everyone. So, I think, Mr. Modi, you've raised a lot of questions in terms of the uncertainties that sit in the sector today. But I think it's important to look at those uncertainties with a backdrop of where we have reached from vis-a-vis where we started. Okay, so back in 2009, 2010, we were at 18 rupees tariffs and a few megawatt scale was supposed to be big. At that time, Jawaharlal Nehru mission said that we'll get 20 gigawatts by 2022. Today, 10 years hence, we are sitting with a 40 gigawatt installed capacity, tariffs sub of 3 rupees, and I'll take that in a 2.5, 3 rupee range. And then we're looking at all these questions and saying, oh God, the sector has so much uncertainty. Sometimes infrastructure is a long-term play. You have to look things in a span of 5 years, but you cannot look them as an interim immediate point. And that today that interim immediate point is of uncertainty. But of a larger outlook, if I look at it, the sector is strong and here to stay. We are at the economic proposition of being sub conventional power prices. It itself is the core value proposition that solar gets. Let's assume the prices change by delta 10%. The 3 becomes 3.2 or becomes 2.7. That delta 10% is still lower than coal pricing. So inherently the sector is strong, is no longer a CSR solution, but an economically viable standalone sector, which is ready to take the conventional sources head on. So that's the standing base, which is why in my personal belief, I believe that if the right policy support and the right infrastructure in terms of evacuation is available, we can surpass the 2030 target. Because as we sit in the market today, it is a very enabling market in terms of financing available. Even though there is price uncertainty, there is enough supply available, right? As we speak, the limiting thing that has happened is us as developers had projected certain kind of prices and bid based on those. Unfortunately, the market has turned differently. So the margins that we all expected are shrinking down as we talk today. However, this is a short-term blip. There'll be multiple correction scenarios that will happen in the future. And if not, irrespective, the future bids will see this correction happening. And you can also already see that with the last Gujarat bid that has been at a higher level than the prior ones, right? So again, like I said, infrastructure cannot be looked at one point in time. It has to be looked in a larger frame of duration because it's a longer term play. In the longer term play, we have covered a long journey and proved that this sector is here to stay standalone. And if I look at the future outlook, I think it is super bright because this is the one power source where the fuel is free, land is available, we have proven the technology, and the questions that are being asked now are the questions which you will ask a mature industry of. Like, how will safeguard duties on an import change your life? How would the interest regime change your life? These are all questions that you ask a well-developed and a matured industry. You don't ask this to a marginal sector. So that's my overall view on how I see the sector. And I also see that in terms of scales. Each of us started with a 1 megawatt, 2 megawatt scale. Today, my largest project is a 200 megawatt project that I'm building, and even those look small in today's era. So you have to look, when we look at the present day, we have to look at it in the perspective of what we have achieved, and then thus look at the perspective of how the future of building India's power of 50% from renewables becomes real. In terms of specific commodity pricing, yes, today, as we stand, and as Mudit also showed in his presentation, there has been, setbacks in terms of the polysilicon price, both by GCL factory. There has been increase in freight. There is increase in the steel price. There is increase in the aluminium price, which is all directly hurting us as developers. But again, this is a fun-time problem that we are facing. We are all, literally waiting to say what is the right time to procure. Because in the projections that we made, we never anticipated a 40% hike for our numbers. We did anticipate some inflation adjustment, but not a 40%. So that is hurting our margins. But as we look at the longer term outlook, that is still bullish. If we don't see a correction in the pricing in the next few months, then we will bake those numbers into the bidding we do. And it is not just us, it is the whole larger community of us as developers who will do it. Because at the end of the day, the beauty of a bidding process is the economics is the same for everybody, the external economics. And it's not like you have a set floor benchmark that you have to start there. It's an open bidding. So the market is the same for everyone. So thus, in my opinion, I see a very strong bullish growth coming in for renewable and specifically for solar. There is a short-term problem, but this short-term problem is no different than the problem that we saw 5 years before or 8 years before, when the module prices were $2 per watt peak. Now from $2 a watt peak now, given that it's 30 cents a watt peak, we are like so tensed because we have gone down to 20 cents in the bag. But when you compare it to a $2, from $2 you came down to 20 and 25 cents also. So inherently there is hope and there is economic proposition in this whole thing. There will be minor ups and downs, and that 10% up and downs should not change the outlook of a larger sector per se. Yes, short-term things will change, but that happens in every industry.
Thank you. I think that's quite useful. In fact, I think one point that you made with respect to the economic rationale of the entire thing, I think that makes a lot of sense. And yes, you have rightly predicted some of the other questions I'm going to ask when you said we are a mature industry. So in fact, that itself is in fact my next question, and I will direct that to Nitin. So Nitin, I wanted to get your views on the interest rate cycle that is we are looking at from here on. Obviously, we have enjoyed for 2 years a very benign interest rate cycle where rates were actually going down. And now it well and truly seems that the cycle has turned. So want to have your thoughts on that with respect to how that affects in terms of your projections, your margins, how you build this going forward, number one. And number two, even and you come from a an equity backed platform, this thing. So we also want to understand your views whether that has impact on valuations eventually, and as to what investors will expect from this sector, or that will automatically adjust.
So yeah, thanks, Mudit, and good afternoon to everyone. To answer your first question on the interest rate, I think most developers would have seen the last 2 years as an exception and not necessarily the rule. And while the interest rates were lower and we enjoyed lower interest rates, I'm quite sure most developers would have baked in an increase in interest rate at some point of time in the future, because I think it was very clear to everyone that those were specific actions taken by the central government, Reserve Bank of India, to boost the economy. So while the interest rate, perhaps I don't know if everyone was expecting the interest rate to be as severe as it has been and as fast as it has been, but our view is that interest rate cycle has, we haven't seen the last of increase in interest rates, and we will continue to see that. Does it, has it impacted some of our investments in the past? I think where the tariffs were priced in perhaps at slightly lower interest rates, you're obviously going to see a hit on returns, because as our PPAs are kind of fixed term PPAs, 15 years lock-ins with no change in the tariff, especially on account of interest rates. That's a risk that the developer is required to take. So will there be a negative impact on returns? Possibly, yes. It'll be a function of what you projected as your interest rates to be when you were actually giving out those those tariffs to customers. So I don't think it's something which is completely unexpected, and I don't think it changes the economics of the industry we are in. I think we will continue to factor in these interest rate changes going forward as well. And I think some of the burden will be passed on to the ultimate customer. Because as I said earlier, we bake in all our assumptions right up front, and those if there's an increase in interest rates, we typically would pass at least some of it to to the customer at the the customer's end. So I think to that extent the market has to move. I don't think the market has yet moved, or the tariffs have yet moved to the stage where we are passing on the entire interest cost impact to the customer. But eventually, or as Tanya mentioned, eventually the industry will move together. And while there will be interest rate differential between various developers depending on the size of the developer, but the fact that the interest rates are increasing will be increasing for all of us and not for some of us. So I think to that extent, eventually we will start passing on some of it. Some of it we will absorb. Some of it we are hoping our lender partners will absorb, and some of it we'll kind of pass it on to the customers. So that's with respect to the situation on the interest rates. I think the second question was.
So I was also in terms of your equity threshold returns.
Valuations. So yeah, I don't think the return expectations are changing much from a developer perspective. But what I've noticed in the last 2 odd months, since we've seen high inflation, not just in India but globally, and the interest rate cycle move up across the globe. I mean, be it Europe, be it the US and India. I think the general belief is that valuations would take a bit, will take some beating. The question is how much. I think we'll know when the next transaction closes. But compared to what happened over the last year and a half, 2 years, where the valuations were quite rich with respect to some of the acquisitions or fundraisers which happened, I think we will see some rationalization there, and you will see some reduction in the valuation. But I yet think there is, valuation is partly return expectation and partly driven by demand supply. And I think there's enough demand there from people globally for Indian renewable assets. So my view is, while there will be an adjustment downwards on the valuation, I think it won't be substantial, because demand for Indian renewable space seems to continue to be robust. And I think the demand will outstrip supply, at least in the short term. So you will continue to see some rich valuations, but not necessarily at the same levels we've seen in the last year and a half.
Sure. No, I understand. So I think it's quite prudent that, especially on your first point with respect to how you're taking in your assumptions with respect to the movements, because this is something which on a longer term does become quite difficult to predict.
Yes,
absolutely. Tanya, I will move to you. I think Ritu is not around, so I'll just direct the next question back to you. This is specifically on the huge requirement commitment that India has on modules now, and with respect to achieving the targets, considering now that the BCD is being imposed or ALMM is coming in place. So how do you see India's domestic model manufacturing sort of coping up to meet this requirement? Do you see that from a demand side as well as from a cost side, this is something that will be there, support the growth that is projected?
Yes. So, very interesting question. And I think one that the whole industry is bipolarly split on. Okay, let me first start with the fact that, in my view as a developer who has actually used modules across players, international and Indian, I feel that the Indian modules are at par or maybe even better in terms of quality vis-a-vis the international peers. And that's one of the most foremost and most comforting thing to sit on, as a technology and in terms of the quality of the product being created. It is in line with the global benchmarks and at some places even outperforms the performance, because that's one of the questions that I've heard from a lot of people to say, okay, price is one thing, but will this thing work? Is it the same as getting things imported? And the answer is yes. It is not like they're using any cheaper material or the bombs are inefficient or the cells are different. A lot of the time what people don't realize is the cells are still the same set of cells which are being used in the international counterparts. So let's keep that first focus in. The second point is actually a very core point in terms of the inherent available supply that we have. So today, as we talk, there's about a 10 gigawatt module supply of domestic manufacturing, of which very high watt peak capacity will only be in the range of about 3 to 4 gigawatt. However, as we sit today, in about 1 to 1.5 quarter, there is another 6 gigawatt of high watt peak module manufacturing going to come online in terms of the factories that are already under construction. On top of this, with the recent PLI scheme that got announced for the first 4,500 crores and then the additional 10,000 crores that's going to do, that will bring in further supply of 10 gigawatts. So if I look at the problem, say 2 years hence, we would be sitting with a good 20 to 25 gigawatt of domestic module capacity with north of 15 gigawatts of high watt peak, which will be more than sufficient to power the domestic demand that you will have. Now, however, that's a 2-year hence outlook. If I look at the interim timeline, today there is a higher demand than supply. The problem that is happening is the demand, while is available, the supply is at such a high price that it's not able to satisfy that demand, right? So which is why it's like a chicken and egg problem. For the module manufacturers, they have capacity available, but nobody is off taking. For developers, they want the capacity, but the price is so unreasonable that they cannot take it. And that is a nexus that needs to get broken, which is where the government intervention has also been taken place. A full PMO office has been put in place to do that. Ministry is very actively working on it. There is a forum being built between developers and module manufacturers to how can we align this ecosystem and get things in place. So if I think about it in the short term, there is an issue both in terms of commodity prices going up, which is hitting the module manufacturers and thus hitting the developers in return, and a demand supply gap. But that is something that we all have to work towards in the next 1 year, 1.5 years. But if I look at it forward and look at the vision that we have as a country for 2030, we are in a very secure state and believe that this can happen. Now, is there policy interventions that can be done to make this work? Yes. For a short period of time, can there be certain waiver on maybe if not duties on modules, but maybe even on cells, which domestic guys use? Or can there be certain postponement of projects that are mandatorily needing ALMM? Or there can be allowance that people who have got a BIS certification are also being allowed. So there is definitely work that needs at the policy level to solve this short-term issue. But as a longer term, I feel that the industry is in a good place.
And you don't see in the short term from a supply side disruption also being there, right? In terms of the quantum of the availability. One is the price, but
see, the quantum of the availability is still not the problem. today as we sit. Just pick up a phone, talk to Gauri, talk to Vikram, talk to any of the likes. They will say, I'm sitting with capacity. People are not off taking it. They are on the other side of the problem, worried that their module lines are generating modules which are not being off taken and picked up. So actually, it's not just a supply issue. It's a price linked supply issue where the demand is for a lower priced product, because that's what we as developers had inherently baked in our financial models to bid for. Now, if I'm going forward, I have to bid for a thing, I will not bake in prices which I used to assume of sub 20 rupees. We know the reality today, so we bake that reality in today.
No, that's a very interesting point. In fact, this is something at least it's not widely reported, and I think very nice, very important that you clarified this.
Stats in terms of the module manufacturing lines available today with like some tier 1 Indian module manufacturers producing but not being off taken, and that's one of the biggest worry as module manufacturers. And I'm a developer. I'm all fair to say that, boss, give me an open era, give me an open regime. I won't. But I am as a thing, I would want the country to grow. For me and for us as Solarise as a group, we have no problem with duties or this thing. What we have problem is clarity. If we as developers will know things upfront, we will bake that in our financial model. We bake that in the way we bid. The issue comes in when there is not enough clarity, when a policy is put in, but the underlying infrastructure needed to make that policy work is not there. Like ALMM being put it, but not enough capacity for high watt peak ALMM modules being there. So if the policy is enabling, the Indian module manufacturing and the supply is in a good state.
Thank you. Very useful. So Nitin, I just want to turn this question a little bit and ask you something similar. One, obviously on the same thing. So as a CNI player, where specifically in terms of the capacity that you offtake versus a utility scale player, it is smaller. So do you at any point of time do feel that you are crowded out, or in terms of priority, are you sort of as a CNI player, are you sort of put behind in the priority list? That is one
you
question.
Mean with respect to module manufacturers?
With respect to availability of modules, yes.
So to date, I don't think we've had that problem. So, unlike the utility scale players who, as of 1st April, are required to only use ALMM based modules, we obviously had the option. We've obviously till as of today have that policies kicking in from 1st of October for ourselves. Having said that, when we were importing modules, I don't think we had that issue at all. And I agree with Tanya when she says that domestic module manufacturers are happy to sit on the table and discuss offtake, but the problem is not necessarily the capacity available for them to manufacture. The problem is the price at which they possibly are selling it to you. And and I could be wrong here, but somehow I think the Indian manufacturer is looking at the delivered price of a foreign module, and then trying to price himself according to that. So I think that is what needs to change. And of course, the big question mark is when do we start manufacturing these cells ourselves? Because ultimately a large part of the costs which goes into manufacturing of the module is a cell. And as long as we are importing, I think most of the cells from China, and there is a 25% custom duty, there's always going to be that, we are importing it, and hence to that extent, the modules are going to be expensive in India. So to answer your question, are we crowded out? I think the answer is no. I think we've been in discussions with at least 3 or 4 of the domestic players, and they have shown keenness to work with us to meet our demand, of course, which is not in the same scale as that of a utility player, but they are happy to work with us. The question is, at what price can we get those modules, and whether those modules at those prices make sense for us from both sense to me from a return perspective and to the customer. Ultimately, the customer has to buy the power I'm generating at say 35-36 cents. And if he's not ready to buy 35-36 cents, then I'm not either I accept that my returns are going to be lower, or then I'm not setting up a project because there is no market for power at that range.
I think that's useful. So I have, another question for you, Nitin, and this is specifically on these green open access rules that have recently come out, specifically with respect, it's very recently come out. And do you see that the CNI market will sort of explode or will go through a change because of this?
So as a policy per se, I think it is very encouraging. I think some of the things which they've mandated banking, they have made other subject to availability of capacity. Open access is kind of a compulsory requirement. Utilities cannot turn down developers or off takers. That I think is extremely encouraging and should encourage the green, the open access market per se. However, having said that, I think the question is whether the government in its power had the ability to actually issue these guidelines. I understand this is the domain of the ERC, which is the central CERC, and then to be adopted by the respective states through the ERCs. So whether the policy per se will percolate down to the states and whether the states will adopt this policy is what we're going to have to wait and watch and see. And if they do, yes, I think it will have a substantial delta impact on the demand as well as comfort, because it gives you one, the policy is out there and there's consistency of policy. It doesn't mean that now it's not going to change every 6 months or every year or every 3 months. How the policy is going to pan out. So to that extent, yes, it's a great policy, but whether it gets adopted at the state level is something we're going to have to wait and watch.
I think absolutely. I think in India, I think implementation is the key.
Yes.
And that is something we have to wait on. So, Tanya, coming back to you, so we've discussed a couple of important or many important points you've addressed with respect to cost, with respect to the ALMM thing. The other big elephant in the room is the DISCOMs, and that there, probably nothing has changed. These interest rates go up and down, costs have gone up and down. DISCOM health has been where broadly it has been, and considering that, especially on the utility scale, eventually they are the end consumers or the end buyers. So how do you see? Do you see eventually the risk increasing because of that, or this is something it's just going on and we can nothing will happen or things will just go on like this? I just want to have a perspective around this.
Sure. So, for me, a Solarize, which is an entity funded by global investors, investors who look at a larger outlook, it's a question of concern when a DISCOM doesn't pay you for over a year. And that does bring in a lot of uncertainty and nervousness from the investment group. Having said that, we also have to look at India in terms of the central and state. So today I run 2 projects with SECI. And those projects, irrespective of whether they are being paid by their respective DISCOM or not, are always paying us on time. Sometimes even before time and charging a rebate. So in that sense, a large part of the portfolio, and for us and for the nation, which is backed by the central off-takers, SECI in that sense, is secured. And the government is creating what I would say a semi-layer in middle to safeguard the developers from a risk of late payment. However, there are also, I would say, like a large chunk of the market, almost 30% of the market, which is with state DISCOMs. And while some states are great and paying ahead of time, there are certain states in the south which have lagged behind it, which is creating a lot of nervousness in the system. So our safeguard to this as a developer is I will not do a further PPA with them till I see the situation changing, because that's not a risk that I can bake into my financials or in my projections as I start, right? So we would look at the credit rating of a DISCOM. We would want to be sure that we see the history of its payment in terms of both the renewable solar and the wind portfolio, and then take a calculated call. And in case we believe that there might be delays, we'll bake that in the financial model of how and when we'll bid. So you will see in that light that the SECI projects may have a slight reduced tariff vis-a-vis the state projects, because you will then bake in that assumption. But if I look at a larger outlook, there is a very strong policy intervention needed to make the DISCOMs whole. Because if the DISCOMs are bleeding beyond a point, they cannot continue to work this way. However, a bleeding DISCOM will choose the lowest cost of power. When solar was the highest cost, we had a problem by saying, oh, you will not give subsidy, but you are no longer in that regime. The DISCOM still needs power. Now coal is more expensive than solar. So there was a time when you were blending coal with renewable. Now it's the other way. Renewable power is being blended with coal to make coal cheaper. So the problem I think is no longer of just renewable energy. The problem is a standalone problem of making DISCOMs whole, which is like a separate policy intervention which needs to happen irrespective to make India a country which functions well and provides the electricity the right way. Renewable just happens to be stuck in this wormhole, but in a good position that it's actually cheaper than the other conventional power today.
I think very well articulated. One more follow-up point with respect to a couple of other things that have been in the news recently. This Great Indian Bustard and undergrounding of transmission lines, and any thoughts around that aspect as well?
Sure. So GIB has taken the sector for a hit for some time. There has been uncertainty for almost a year, because of which most bidding work in the sector or upgradation work all paused. But there has been slight relief in the recent past, as Supreme Court has given a favorable order to say that yes, underground transmission lines is not feasible. The cost that it puts in the project is not viable, and there can be bird diverters and other infrastructure like that that can be put to make this thing whole. So I would say this is a problem that came up unanticipated, but in the path of recovery, as not just the developers, but even MNRE is strongly working with the legislative system to find a solution around it. And the interim solution seems to be bird diverters, which is a feasible and a possible solution to save the species and not harm the renewable cost as well. So I would say that in another few months, we would be able to put this issue behind us. The industry has been patient. It has taken a slowdown, specifically in the regions of Rajasthan and Gujarat. But now is the time when you will see that uncertainty being taken off and work starting back again.
Nitin, I just have, I have one more specific point for you. So especially if, as somebody very active in the CNI space, and you work with a lot of end industries and end consumers. And a lot of these consumers have now declared an ESG focus. They have declared, greening of supply chain, greening of power. So do you see from here, where do you see the market going, especially in the CNI space? Do you see in terms of growth, it really increasing? That is one question. The second question is that unlike obviously in a utility scale PPA, you have a little less wiggle room for changes. But in the CNI space, in terms of if projects get extended or in terms of there are tariff pass on issues, do you see customers becoming a little more lenient or at least willing to hear you as a developer there?
Okay. Let me answer the first question. If I remember correctly, last year, that is FY22, the CNI market was somewhere around 1.3 or 1.4 gigawatt, of which I think solar was largely 85-90% and wind was the balance. I understand the current financial year, we're expecting it to be closer to 2 gigawatt, with solar being about 1.5, 1.6 and wind being the remaining capacity. I think demand continues to be robust. And I think I'll pick on what Tanya said, when she started the discussion, that solar on a standalone basis now is a viable alternate to coal or any other, energy source that is there in the country. We are not in a regime where solar requires, subsidies, incentives for it to be viable, and it needs incentives for the customer to offtake. So the CNI market, as it is grown, has not grown because it's green. It's grown because it's cheap, and the savings to a customer today vis-a-vis the grid tariff which he's off-taking in most states, and I would remove states like Chhattisgarh and Jharkhand and Bihar and Orissa, where tariffs for industry are low, is typically ranging from anywhere between 1.5 rupee to 2.7, 2.8 rupees. So the incentive for the off-taker to move from his off-taking from the utility to an open access, especially under captive guidelines, is very attractive. He saves a lot of money. That is one. Second is, you're right that a lot of companies are ESG focused, and a lot of lot of industries, be it auto components, be it textile, be it steel. When I say steel, I mean steel tubes, steel pipes, and so on and so forth, have customers in Europe and the US, which requires them to be green. So while that is an incentive or a requirement for them, that adds to the reason for them to move to green, along with the fact that green energy is cheap. Or cheaper. I wouldn't say cheap, but it is cheaper for them vis-a-vis what is available from the utility. So I think demand is robust. Demand, I think, will continue to be robust. I don't think this is going to change over the next 2-3 years. I think we will continue to see more and more demand. And you're seeing that also from the number of players who are out there. I mean, and I'm sure Tanya follows this, but a lot of the utility scale guys are now looking at large scale CNI, projects. So we don't only have competition from people we've been dealing with in the last 4-5 years, but a large number of the utility scale players are also now looking at CNI. So I think demand is there. That I don't think is a challenge and will continue to be there as long as we're competitive vis-a-vis utility, what they're paying, grid tariff, which they're paying currently in the market. To answer your second question, whether customers are lenient, typically we haven't seen them to be very lenient. There is resistance even in, when, and I can give you an example, when GST was increased from 5 to 12.9 or 13.8, sorry, from 5 to 12%. We did see pushback from customers on, wanting to increase the tariffs, even though you had the provisions in the PPA for pass on tariff. So they are reluctant. I don't think, even like, I think the utility scale PPAs would perhaps have it easier than private PPAs when with its ability to negotiate, if you ask me, because the government at times does see logic and reason, and it understands for the larger interest of the industry as a whole. It is important to address certain issues, and I think they've done that in the past in sectors like road as well, where certain changes have been brought about simply because the industry as a whole needed them. And I think they would do that in the utility scale projects as well. On the private side, the contract kind of becomes a sacrosanct document, and to make changes from what is agreed in the document becomes difficult. But I think with respect to timelines, we do see customers understanding the fact that there could be delays, and land is a challenge. Getting approvals can be a challenge. So to that extent, they do see reason and would not necessarily impose the penalties which are typically baked into the PPA. But from a tariff change or increasing tariffs, I don't think we have too much flexibility there.
Very right. Absolutely. So I think I've been asking all the questions, and I think we have a few attendees. We'll give, we'll have some time for question and answer.
Sure.
So in case anybody in the audience has some questions, I think this is the opportunity.
In the Q&A part, go to the published one. There are questions which you can then ask.
Let me just see. Published. Okay. So I have, so we will go with yes. So there's a question on PLI incentives for PV modules. Can the investment come to India due to manufacturing incentives available now? PV modules at a cost has been a hype for the past few years. Well, I think Tanya, you partly answered that, but maybe if you want to just have some quick response.
I unfortunately cannot see the live Q&A. Can you repeat the second part of the question?
The PLI incentives for PV modules, can more investment come to India due to the manufacturing incentives available now? PV modules as a cost has been a hype in the past few years.
Yeah, so I think the PLI scheme is an incentive to ensure that the capacity increases. The capacity increasing is, I would say, more of the Indian players who may then take funding on basis of IPO or international financiers or international equity. But the scheme per se is limited to Indian entities who want to build lines in India. So in that sense, it will help grow the domestic module manufacturing. And obviously, given that there is an external incentive in terms of VGF and the PLI scheme, there is a certain amount of subsidized element that is available to the module manufacturers, which should safeguard the price that they charge the final developer, because a part of that is already covered by the money received in PLI scheme. So it should help reduce the price of the final product as available in the market, had there not been a PLI scheme. And this is the government's way to promote the domestic manufacturing while ensuring that there is harmony between the developers and the manufacturers.
That answers Harshvardhan. We have one more question, which says imposition of custom duty increases the tariff. What do you think by when India will be able to become self-dependent on domestic solar panel? What do you think of green H2 demand in the upcoming future? Will this push the renewable sector in India?
Sure. So I think I answered part of that question by saying that you would see 25 to 30 gigawatts of module manufacturing capacity in the medium term. And I think that would be sufficient to inherently cover the domestic demand. But I personally, given my interactions at the ministry, the level of policy discussions we have had, I do not see the BCD going away anytime soon, or even in the medium term. I think that's something which is here to stay and will continue to stay. And that's not because the domestic module industry would need that as a crutch, but more as a deterrent for international players to come in, because at the end of the day, we want some penalty to be there at the ministry level. So that's the first part of it. And there was second part of the question.
The second was on green hydrogen.
Green hydrogen, yeah. So the green hydrogen thing, I look at green hydrogen and saying, yes, solar was in 2010, green hydrogen is today. But solar took 10 years or 12 years to become to the scale it has. Green hydrogen will take 1/3 of that time. And obviously, green hydrogen has a huge part which is green and hydrogen. So the green part will come from renewable, which will further fuel the growth of solar and wind. You would definitely see that. And there is a lot of misnomer on saying green hydrogen is a new technology, it's different. A lot of that is not true. Electrolyzers and hydrogen in India has been available for, insane number of years. What you're doing is you're changing the power source, whether that power was coming from a coal generated plant to now a solar generated plant. That's the core difference. So in that sense, obviously, whether it's green hydrogen or whether it's any electricity demand, it will help grow the sector. The core, this thing that will change the economics for green hydrogen is when you see integration at the DC level and not have full solar power generated, then using it on electrolyzers, but at the DC level of the solar power itself, using it for electrolysis. That's where the step change on revolution and pricing will come to make it sustainable.
Absolutely. I can't agree more with you. So I think I'm not sure if we have any questions. Case Nitin, any closing thoughts from your side, and maybe then no further questions. We will sort of.
Sure. I think couple of things. One, what Tanya said right at the beginning. This industry is self-sufficient and at a cusp where we should be growing and growing rapidly, which is what we've seen over the last 2-3 years. I mean, I would say since 2017, 2018, when we really started seeing large utility scale projects coming in. I think you're going to see also the CNI sector explode over the next 2-3 years, where you're going to also see larger projects on the CNI space come in. I think the green, as I mentioned earlier, the green open access policy is very encouraging. The green open access policy also touches upon green hydrogen, where it very clearly says there are certain benefits for green hydrogen if they were to go in, including waiver of cross subsidy charges under the green hydrogen policy. Again, whether this gets adopted or not we'll only know in time. But if green hydrogen is to be a reality, we're obviously going to need incentives both from the regulator through the electricity side, but also incentives for people to consume green energy or green hydrogen rather. So that's something we believe will surely come in. And I was just seeing one question which came in. Are we going to see dedicated utility scale plants for green hydrogen? I think the answer is yes. You will start seeing those 100 megawatt, 200 megawatt plants dedicated to green hydrogen plants going forward. And it won't just be I think there'll be round the clock kind of plants, because green hydrogen is going to be a 24-hour process. And the solutions will also have to be 24-hour, and it can't be specific to, because if it has to be green, then there can't be any element of utilities power there, or you pay for the green utility power. So I think solutions to that effect will come in. Larger scale solutions will come in. And I think the players are geared up to meet the requirements of the industry going forward. A lot of it is going to be dependent on how state utilities, uh, work with developers to encourage green power. I mean, given it is concurrent subject, and at least for players like us, the state becomes a very important player in our ability to grow. So to that extent, I think over the next few years, we'll have to wait and watch how the states engage with CNI players and see how we can roll out these capacities. But I think we're at a good place, and growth, at least for the next few years, should be quite robust.
Thank you. Thank you so much. Anything from you, Tanya, on closing thoughts?
Well, I think I started with my closing thoughts to say that solar is here to stay, to take the conventional sector head on. I actually foresee with the right policy intervention that we can beat the target of 2030 and being 50%. It's also important to note that with just 7% of the Indian desert, you can power the whole of India. Imagine if you populate 14% of the Indian desert, what would it do? You would actually become a superpower, and you would be able to generate so much electricity that it will revolutionize and change the way we all operate. Whether it's electric cars, whether it's usage of electricity at home, whether it's hydrogen, whether it's anything that can use power, it will just revolutionize the sector. And there is one very famous quote that I myself have coined, and I say that there was one point of time when solar was an idea. Today, as we sit, it's a necessity. Tomorrow, it will be a revolution, and I'm waiting for that tomorrow.
Super, super. No, excellent. I think you can't put it more aptly. So, thank you so much, Tanya. Thank you so much, Nitin. Thank you, Mudit. And I think the audience has benefited, I'm sure, immensely from the insights that we got today from both of you. And it's been a pleasure, at TCCL to have you. We look forward to interacting with you and hearing you more often as and when we have these events in the future. Thank you so much. Thank you.
Thank you.
Thank you.
Tanya. Thank you, Nitin.
Muditji, I'm ending the event.
Yes.